If you are already a software developer and you are trying to enter FinTech, quantitative finance, trading, banking, payments, or investment technology, there is one question you hit almost immediately. How much finance do I actually need to know? Do you need to become an accountant? Do you need a finance degree? Neither one is a prerequisite, but there is a floor and it is lower than you expect. Financial software is not ordinary software with money added to it. The moment value moves through your system, it brings a ledger with it. Precision rules, an audit trail, settlement, risk, and compliance. So let us build a map of the finance knowledge a software developer actually needs. 9 territories: money, instruments, markets, data, risk, banking and payments, credit, investments, and the rules around all of it. You do not need all 9 on day 1. Start with the arithmetic money runs on: percentages, percentage points, basis points, compounding, returns, present value, and future value. A rate moving from 4% to 4.25% rose by 1/4 of a percentage point. That is the same thing as 25 basis points. One move, 2 notations, and financial systems use both. If an investment grows by 10% this year and loses 10% next year, you are not back where you started. 100 becomes 110 and then 99. And money has a time dimension. 100 today and 105 years are not the same quantity. Discounting is how you compare them. Then learn what the instruments actually are. A stock is ownership, a bond is debt, a fund is a portfolio in one wrapper, an option is a right, a future is an agreement. An equity trading system does not behave like a cryptocurrency exchange. One has trading hours, corporate actions, and settlement cycles. The other runs continuously with wallets and on-chain confirmation. The domain changes the software. Markets are where those instruments change hands. At the center of one sits an order book. Buyers stacked on one side, sellers on the other, sorted by price. The best bid and the best ask sit at the touch. The distance between them is the spread, and it is the first cost every trade pays. So when a user presses buy, the button click is only the beginning. The order travels to a broker, into an exchange, through a matching engine, and then onward to clearing, to settlement, and finally to custody. All of that produces data. Trades, quotes, and order book updates arrive as a stream of events. Bars are not given to you. They are something you build from that stream. Markets have opening and closing times, holidays, and time zones. Events arrive late, arrive twice, or never arrive at all. Splits and ticker changes rewrite history. Financial data engineering is a discipline of its own. And if you test an idea using today's list of companies against data from 10 years ago, you have already leaked the future into the past. The question is always what was knowable at the time. If an investment produced a return of 10%, that number alone tells you very little. Pull the camera back and you find volatility, drawdown, correlation, and how bad it could plausibly get. 2 portfolios can end the year at exactly the same return. One of them walked there. The other fell 40% on the way. Those are not the same investment. So the vocabulary matters. Volatility asks how much it moves. Correlation asks how things move together. Drawdown asks how far it fell. And value at risk asks how bad a bad day could be. Now change domain completely. Close the chart and open an account. Balances, cards, ledgers, and payments. Here is the rule that matters most in this whole section. Never treat money as just another number in a database. A balance is not a column you assign to. It is the result of entries, and every entry has 2 sides. A card payment is a state machine, not an event. It is initiated, authorized, captured, cleared, and finally settled. And it can be declined, reversed, or refunded along the way. Rounding matters. Currency precision matters. Dollars carry 2 decimals and yen carries none. And if the same request arrives twice, it must still produce 1 payment. That property is called idempotency. Lending is a decision engine. An application arrives carrying income, existing debt, credit history, and the amount requested, and something has to answer. The vocabulary here is probability of default, loss given default, and debt to income. Together they produce a price. The interest rate is what the risk costs. A portfolio is not simply an array of stocks. It is an allocation, and the weights are the decision. Take 2 volatile assets that tend to move against each other. Hold both, and the combined line is calmer than either one alone. Risk depends on relationships, not only on individual holdings. And all of it sits inside controls: identity checks, anti money laundering, sanctions screening, access control, audit trails, and reporting. In ordinary software, a bug is an inconvenience. In financial software, a bug is a duplicate payment, a wrong balance, a misstated report, and a conversation with a regulator. So do not try to learn the entire financial industry at once. Build it in layers. Money, instruments, markets, data, and risk come first. Then choose one branch: payments, lending, wealth, trading, quant, insurance, or the infrastructure underneath all of them. Because every financial system you will ever build rests on four questions. Finance asks, what does this mean? Engineering asks, how must it behave? Data asks, what actually happened? Regulation asks, what rules apply? Answer all four, and you are doing FinTech engineering. That is the shift. The screens stop being question marks and start being market data, a ledger, a risk model, a portfolio, and a payment flow. You start thinking like a FinTech engineer. And that is what we build here. From the financial concept to the formula to the algorithm to a typed contract to Python and TypeScript to tests, and finally to something that actually runs. Welcome to the FinTech Builder. Every layer in this video becomes an article, a working algorithm, and code you can run. Continue at thefintechbuilder.com. Let us build finance from first principles.